So after last week's episode, I was just taking a quick look at the portfolio again, and I realized that we are going to run out of cash very quickly. So my immediate reaction was to really go through the portfolio and see what underperformers we have so I could sell out of those to make some additional purchases. But we don't really have any underperformers, so it's a good problem to have. So my next instinct or next reaction was to think about maybe some income producing investments. But not just any income. I was really looking for some monthly income to help grow the cash position in this portfolio. And I think I knew just the stock for that. So for this week, we're going to be taking a look at Realty Income. Hey everyone, and thanks for joining me today. My name is Matt, and as I mentioned in the intro, today the stock I'm going to be taking a look at is Realty Income. Before we jump into that though, I just have to say this isn't financial advice. Please don't take it as financial advice. If you have any questions, speak to an advisor. This is just for your entertainment. So let's go ahead and start off with some background information for Realty Income. So Realty Income Corporation is a REIT. If you're not familiar with what a REIT is, it stands for Real Estate Investment Trust, and basically what it is, there's many forms of it, but in a nutshell, it is real estate investment properties, and they pay dividends through income that is produced from these investment properties, whether that be somebody's rent payments for a single family residence or rent payments for office buildings. Anything in between, it's just kind of bundled together, and then the dividends you receive are again through those payments. That's kind of a high level overview. There's a lot more detail tied to REITs, but just so you have a general understanding for what they are. Realty Income primarily invests in freestanding single tenant triple net leases. A triple net lease basically means that the tenant in the facility or the person renting out the space is required for maintenance, insurance, and property taxes. Now, since the tenant is responsible for those with a triple net lease, that generally means that they would pay a lower rental rate than they would if the landlord was responsible for all of those. Realty Income started in 1959 and has since expanded their business to 49 states in the US, as well as Puerto Rico and the UK. Some of their tenants that you might recognize include Walgreens, 7-Eleven, and Walmart, but we'll touch more on their tenants later. One of the reasons that I found that this was an attractive investment, and one of the reasons why many investors like Realty Income, is because they do pay a monthly dividend. In fact, they have now paid 601 dividends in a row, which is a crazy long streak. So the next thing I want to talk about is what I like about Realty Income and why I chose this one for this week. The first thing is I've been wanting to add more real estate exposure to this portfolio for a while now. Currently, the only real estate exposure we have is VNQ, which has done very well for us, but I always think there's room for additional real estate space inside of a portfolio. Also, given the pandemic, I kind of wanted to hold off on real estate just to see how rental rates were affected, what kind of businesses were going out of business, or any kind of red flags that could influence the performance of a real estate investment. But aside from the monthly dividend, I also chose Realty Income because of the types of real estate investments that they have in their portfolio. Another reason why I like this investment is because they were actually able to increase their rental rates from Q1 to Q2 of this year, which I thought was relatively impressive. I get it that Q1 is definitely going to be the one that took the biggest hit, but still, even after that, in a time where there's a lot of forgiveness to rents and people haven't necessarily been needing to pay their rents, for them to still increase their revenue that they receive from rent, I thought was very impressive. Now, you can maybe see a different light of that, but again, as the investor, or I'm looking at this as the investor, and that to me is a really good sign that this part of real estate is doing well. Lastly, according to Simply Wall Street, Realty Income is currently undervalued by about 40%. Now, it's worth noting that you don't typically buy REITs or real estate investments for the capital appreciation. You do buy them for the income. Now, that being said, if a stock can go from $60 to $100, I'm never going to complain about that, and I will be happy with the growth. But again, that's not what we're after here. We're really just looking for the monthly income from this investment. We'll get into more numbers later about them. I only have a few numbers for this week, but I want to point out this model here that I got from Simply Wall Street is the discounted cash flow, which is that same model you've seen me use in previous videos. I just decided to use it this week because really that template that I have is what I would use in college, but Simply Wall Street actually help me understand what those numbers mean and how they're all calculated or what the calculations mean. Again, the templates that I have was just a college project, so I just kind of followed along, and I knew how to do the calculations but didn't fully understand what they meant. And Simply Wall Street has been a really good resource for me to learn some of this stuff from. It's not sponsored by them. Again, I always wish it was sponsored by somebody, but if you're learning how to invest, I do suggest checking out Simply Wall Street. It is a paid service, but the way they display the information is very eye-catching and easy to follow along with, especially if you're a newer investor. I think the website is simplywall.st if you wanted to check it out. So next, I do want to move on to what I don't like. So to start this off, I should address that in order for REITs to receive the special tax advantage or to not be taxed at the corporate level, they have to pay out 90% of their net earnings to shareholders. So if you look at debt levels for something like a REIT, it might appear that they pay out either a significant portion to their shareholders or they might be paying out too much compared to what they can afford. But again, that's because they'll receive that special tax treatment, which will have a positive influence on their bottom line. Also, since they do purchase properties, it's normal for them to see high levels of debt or using a lot of financing because that's just kind of the name of the game when it comes to real estate. So you don't treat a REIT's balance sheet like you would for a company like a Walmart or a Home Depot. It's going to be different because they're not in the same business and they use different strategies for making money, as well as, again, REITs have that special tax treatment. So bear that in mind as well. Now, the reason why I'm putting this in the cons is because it's still not easy to look at a company with higher debt levels and feel 100% comfortable investing in it. But it's something that I always need to take a step back and just remember what I'm looking at, and that sometimes these numbers can be treated very differently depending on the company you're looking at. Another thing I am not a huge fan of are some of their top tenants or tenants that provide them the largest sources of revenue in the top 10. I don't know the best way to word that. I apologize. And with Walgreens being the biggest source of revenue does not sit well with me. They make up about 6% of their revenue. And the reason why I say that doesn't sit well with me is because if you haven't heard, Walgreens is struggling right now. They've been having to lay off some of their employees, as well as been shutting down some of their stores. So if you start getting rid of some of their stores, that obviously means it's going to hurt the income that Realty Income is receiving from Walgreens. If you want to know more about that, you can look into it. I don't want to get into too much detail since this isn't a video about Walgreens. If we look at some of their other tenants, I'm okay with 7-Eleven, Dollar General, FedEx, Dollar Tree, but the next three are also ones I have a problem with. So, LA Fitness. You've heard me say before, but I don't think gyms are necessarily going to be the first place people go running back to after the pandemic is over or lockdown is over. It has nothing to do with people being lazy, but gyms by their nature are not sanitary places. Among other things, it's a place where you could be sitting in somebody else's sweat and they might have not properly wiped down after they were done using the machine or lifting the weights. And that's why I was so optimistic on Peloton or Lululemon buying Mirror, because I think those home gyms are probably the direction a lot of people will be headed in, again, for convenience as well as sanitary reasons. As for the next two, AMC Theaters and Regal Cinema, well, I know a lot of you out there might not like what I'm about to say, and Dad, if you're watching, sorry if this offends you, but I don't think movie theaters are going to be around for forever. And I think it could be a matter of time before they're a thing of the past. I don't think this is going to happen right away. It'll definitely be a slow process, but it's something I feel is worth looking out for. A lot of this has to do with, I think, ever since Netflix started releasing their movies direct to their platform, eliminating the need to buy movie tickets, drive to the movie theater, sit in a theater with other people, and Netflix allows you to just see it there. So a combination between Netflix and now other platforms releasing directly to the platform, as well as the very quickly increasing price per ticket at movie theaters, is not driving it in the right direction. Movie theaters once upon a time were a relatively cheap thing to do on a Friday, Saturday, whatever. But now 2 tickets, and if you want to go as far as getting a bucket of popcorn, could run you about $40 or $50. And so they're not as cheap as they once were. I do think, and again too, you have people going into these close quartered environments that are probably not the most sanitary to pay a premium to see a movie. And I get it, there's an experience side to going and seeing something in theaters versus watching it at home, but I think there's going to be a little bit of a give and take there, and maybe people will sacrifice the full-on experience to watch it at home, where you might have surround sound of really high-quality TV, and don't have to pay as much for a bag of popcorn. That said, and last thing I'll say about movie theaters, is I think the real opportunity for them is going to be in more of those dinner and a movie setups, where you're at your own table with friends and family or people that you actually know. They bring you the food and they create a full-on experience for it. And I could see that's where it's going to head to. I don't know that for certain. I'm speculating here, but my opinion on movie theaters. So, back to what we were talking about, Realty Income. Those 4 companies make up about 15% of their revenue, and if they do start to phase out, close more and more of their operations, 15% is nothing to overlook, and it is a pretty significant portion of their revenue, so it's just something to watch out for. That being said, the rest of these tenants I have no fear in. I think they're all going to do great. I guess with the exception of Sainsbury, because I really don't know what that is, so I'm assuming it's a company in the UK. But 7-Eleven, here to stay. Walmart and Sam's Club, here to stay. Dollar stores will always be here to stay. So I think that the nerves I would have between the 4 companies I listed is outweighed by my optimism for the remaining companies on this top 10 sources of revenue. All right, so I do have just a few numbers here for this week. It's not going to be anything in depth because, again, I'm really buying this for the income. That's been consistent. So I don't necessarily feel the need to go fully into the numbers, but I know that's what some of you enjoy seeing with these videos. So, I can't just skip over this part completely. So just a few quick things to know about Realty Income is market cap of $21.62 billion. So this is obviously a pretty big company. They have a PE ratio of 42.28, which again, you could see as them trading at a premium, but the discounted cash flow model at Simply Wall Street does take into consideration their dividends. So it uses dividends as part of that calculation. And with that being undervalued, I think it's a better and more accurate measurement of the value of Realty Income compared to the PE ratio. That was a mouthful. Sorry if that was a lot to take in at once. Year-over-year revenue growth of 14.3% is great to see. Again, taking into consideration that this has not been the best year for real estate. Residential has been fine, but commercial has taken a huge hit. So that year-over-year revenue growth is a great thing to see. Net profit margins of 30.3%. Again, also good to see because of the large expenses that come with being a REIT. Now, physical assets. This is not something I've ever included in these numbers before, but it was something I wanted to point out because $16.7 billion is a ton of money in physical assets. But if you don't know real estate, that might seem meaningless and nothing to really compare it to. So the best comparison I would have here is the Mercedes-Benz Stadium that they built in Atlanta cost about $1.5 billion to build. Now, you see how impressive that stadium is. That was $1.5 billion. And Realty Income has $16.7 billion in physical assets, but they're not in stadiums. They're in standalone businesses. I think the biggest is probably going to be like a Sam's Club, but even down to convenience stores like a 7-Eleven. So that might give a better picture, help paint the picture for just how much $16 billion in real estate actually is. Lastly here, the reason why we're investing in this one, dividend yield of 4.43%. I think it comes out to just shy of about $2.77. So just shy of $3 a year in total dividend payouts, and with a payout ratio of 83.18%. Now, yes, both of those ratios are high, but we have to remember that this is a REIT, not a traditional stock. So in order for them to, again, receive that tax advantage, they need to pay out a lot of money to the shareholders. So after looking at these numbers, I'm sure this comes as no surprise to you. We are going to put this one in the portfolio, so let me go ahead and do that, and I'll be right back with you. All right, and so went ahead and placed a trade, and we actually now have a watchlist Wednesday first. It was my first time I ever bought a whole lot of shares. Might be the second time. I think I bought a whole lot of Peloton shares too. A whole lot means 100 shares. It's a phrase used in options trading. But so we bought 100 shares of O shares. I think we locked them in at $61.86. So reason why I put so much into it is, again, this has some upside potential, but we're not looking at it for growth. And depreciation is not necessarily a concern of mine when it comes to a real estate investment. I really wanted the income. And so having 100 shares, no, at $2, it's going to be like $200 a year in dividends. So nothing that you can quit your job over, but it's really going to help increase our cash position in this portfolio, allowing us to make additional purchases in the future. So that's why I did get a little aggressive with this one and bought the whole 100 shares of Realty Income, but I think it'll fit well into this portfolio. And just to take a quick look here, so we are up investment-wise $11,533 since we started this. So again, great to see. I was admittedly incredibly nervous. I felt like I hyped up the performance of this portfolio last week, and I was like, I guarantee next week it's all going to be down after being that optimistic about Monster and whatnot. But while Monster is definitely not our best performer, it's doing well, and everything in here is still green, so that is good to see. We don't have any losers in here, but in total gains, including cash, we are up $12,505 so far. So really happy with that. Again, as I always say, love the way this portfolio is headed, and just excited to see what the future brings for this account. But I guess with that said, this is where I'll end it. So if you're interested in getting started with investing, I do have a referral link that you can use for both Acorns to get a free $5 and Robinhood to get a free stock. So check that out in the description down below. If you're interested in real estate, especially in the Charlotte, North Carolina area, there's also a link to my real estate agent website. So feel free to go there and contact me if there's any way I can help you with buying a home, selling a home, or looking for investment properties. If you like this video, I hope that you consider liking it, smashing it if that's something that you're into. And if you haven't subscribed already, I just hope that you consider subscribing to this channel so you can see more videos like this one. If you have any questions, or if you have a stock that you'd like for me to do a review of, please leave that in the comment section down below, and I'll be more than happy to take a look at those as well and create a video for you and help you have a better understanding of these investments. You could be anywhere in the world and you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video, but I will let you go ahead, enjoy the rest of your day, and I will see you next time.